In this video, we're going to be talking about Section 4E that deals with income taxes. And in this case, we're going to be talking about something that's applicable to real life. Every year we do have to deal with income tax. Okay? And there are many types of taxes, including sales tax, gasoline, and property tax. But for most Americans, the largest tax burden comes from federal taxes on wages and other income. And these taxes also represent one of the most contentious political issues of our time. So here we're going to be exploring a few of the many aspects of federal income tax. Okay? Now, I'm going to move this up a bit. It is quite possible that no one fully understands federal income tax. The complete tax code is many thousand pages long, and it changes almost every year as Congress enacts new tax laws. Nevertheless, the basic ideas behind federal income taxes are relatively simple, and most of the arcane rules apply only to relatively small segments of the population. As a result, most people cannot only file their own taxes, but also understand them well enough to make intelligent decisions about both personal finances and political tax questions. Okay? Now, these bulleted points are going to be in what we call Figure 4.13, which I will show you in a few minutes. But here, we're going to define some terms that are related to income taxes. We start off with what we call gross income. Gross income is going to be all of your income for the year, and that includes wages, tips, profits from a business, interest or dividends from investments, and any other income you receive. And then, now, some gross income are not going to be taxed in the year that is received. And cases like that would be contributions to individual retirement accounts or IRAs or other tax-deferred savings plans. These untaxed portions of gross income are called adjustments. If you subtract your adjustments from your gross income, you'll end up with what they call adjusted gross income. Now, most people are entitled to certain exemptions and deductions. Now, those are amounts that are subtracted from the adjusted gross income before taxes are collected. Now, once you subtract your exemptions and deductions, you're going to be left with what they call taxable income. That's going to be the amount that you will be taxed on. The amount of the tax will be based upon your taxable income. A tax table or tax rate computation allows you to determine how much tax you owe on the taxable income. However, you may not actually have to pay this much tax if you are entitled to any tax credits, such as child tax credits that many parents can claim. Subtracting any amount of any tax credit gives you what they call the total tax. Okay. One good example of that would be earned income credit. Sometimes that's deducted from the taxable income to get your total tax. And if you're in college, then there are deductions that you can take. I think it's a Hope credit and also a lifelong credit for a certain amount that you can use and deduct that from your taxable income. And then you'll end up with your total tax. Finally, most people have already paid part or all of their tax bill during the year, either through withholding or by paying quarterly estimated taxes for those who are self-employed. You subtract the taxes that you already paid to determine how much you still owe. Now, if you have paid more than what you owe, then you should receive what they call a refund. Okay? Now, here is that table 4.13, or figure 4.13, that deals with this situation. You start off with the gross income, deduct any adjustments to your income, you can have the adjusted gross income. And from here, we take our adjusted gross income, we subtract from it any deductions or exemptions that you may have, and you'll deal with you'll have what they call the taxable income. Okay? Now, your tax computation will be based on rates or on a tax table. You deduct from that your tax credits, and you're going to end up with a total tax. And from that total tax, we're going to subtract from it any payments or withholding that you might have paid on your taxes, and you'll either have to owe tax, or if you paid more than what you owe, you'll get a tax refund. Okay? That's a typical flow chart of how taxes are computed. Okay? So now let's look at some examples of this. So we'll start with this first example. A woman earned wages of $39,800, received $2,000 in interest from a savings account, and contributed $3,600 to a tax-deferred retirement plan. She was entitled to a personal exemption of $2,800 and had deductions totaling $5,010. Find her gross income, adjusted gross income, and taxable income. Okay. In this case here, let's find out what her gross income is going to be. That's going to be her earned wages plus the interest. And in this case, this woman earned $39,800. We're going to add to it the interest, which was $2,000 from a savings account. If we add those two together, you'll get $41,800. That will be the gross income. Okay. Now, for her adjusted gross income, this will be the gross income that we got in that first part minus the adjustments. So here the gross income that we got was $41,800 minus the adjustments. And in this case, she contributed $3,600 to a tax-deferred retirement plan. That's her adjustments. So if we subtract $41,600 from the $3,600, we'll end up with $38,200. That will be her adjusted gross income. And then finally, what is her taxable income? So now the taxable income we take her adjusted gross income we're going to subtract from it deductions and exemptions. Well, her adjusted gross income is $38,200. We're going to subtract from it her deductions and exemptions here. Okay. Her personal exemption was $2,800, so we'll subtract $2,800 from that. And then we're going to deduct again. She has deductions of $5,010. So in this case, $38,200 minus $2,800 minus $5,010. This will be $30,390. That amount represents the taxable income for this individual. Okay. All right, here's another example of that. A woman earned wages of $34,800, received $1,100 in interest from a savings account, and contributed $3,400 to a tax-deferred retirement plan. She was entitled to a personal exemption of $2,500 and had deductions totaling $4,900. We're going to find her gross income, adjusted gross income, and taxable income. Okay, starting with her gross income. That's going to be the amount of the wages plus interest. So in this case here, her wages was $34,800 plus the interest from her savings account, that's $1,100. If we add those two, you'll end up with $35,900. That will be the gross income. And now for the adjusted gross income. Adjusted gross income, we find that out by taking the gross income minus the adjustments. Okay, now for the gross income, we came up with $35,900. Now she contributed $3,400 to a tax-deferred retirement plan. That would be the adjustments. She's entitled to that. So we subtract $3,400 from the $35,900, and we'll end up with $32,500. That's the adjusted gross income. And now for her taxable income. For taxable income, to find that out, we take the adjusted gross income minus any deductions and exemptions. Now, in this case here, her adjusted gross income was at $32,500. We're going to subtract from it all deductions and exemptions here. She was entitled to a personal exemption of $2,500, so we'll subtract $2,500 there, and had deductions totaling $4,900. So we'll subtract that as well. Okay, so $32,500 minus the $2,500 minus $4,900 will get $25,100. That amount represents her taxable income. So $25,100 is the amount of the taxable income. Okay. So that's how we find the gross income, the adjusted gross income, and the taxable income. Okay. Next, we'll look at filing status. On tax returns, there are 4 different types of filing status. They're in 4 categories. One of them, single. That means the individual is unmarried or divorced or legally separated. Or that person is married filing jointly. That means married and you and your spouse are filing a single return. Also married filing separately. Okay? That means you're married, but you and your spouse are going to file 2 separate returns. And then finally, head of household. You're unmarried and you're paying more than half the cost of supporting a dependent child or parent. Okay? Those are the 4 filing status that are used on individual income tax returns. Okay? All right, next we'll look at exemptions and deductions here. Okay, now both exemptions and deductions are subtracted from your adjusted gross income. In this case here, exemptions are a fixed amount per person, and those exemptions can be claimed for you and each of your dependents. Deductions vary from one person to another. There are 2 types. One is a standard deduction. It depends upon your filing status. That's a set amount. An itemized deduction is going to be the sum of all of the individual deductions to which you are entitled. Okay? Now, you're either going to get to deduct using the standard deduction, or you might use itemized deductions. It's going to be the larger of the 2, especially on tax returns. Okay, let's look at example 3. Decide whether a person should itemize his deductions or take a standard deduction in the following case. A person's deductible expenditures are $8,500 for interest on a home mortgage, $2,100 for contributions to charity, and $614 for state income taxes. His filing status entitles him to a standard deduction of $11,600. Okay? So let's look at what we have here. These are his itemized deductions. Okay. $8,500 on interest on a home mortgage. Okay. He's entitled to that. We'll add to it contributions to charity. That's an itemized deduction, $2,100. And $614 for state income taxes. So we add $8,500, $2,100, and $614. We're going to get $11,214. That would be the itemized deduction amount. Now, based on his filing status, he's entitled to a standard deduction in the amount of $11,600. So now we need to compare the two. Which one should this person use? And it has to be the larger of the two. And in this case, the larger of the two will have to be the standard deduction of $11,600. So here, he should claim the standard deduction because it would deduct more money from his taxable income. And if you can deduct more money than that from your taxable income, that means you will pay less tax. Okay. All right, now let's look at this next example. Here's a tax rate table. And we want to compute the gross income, adjusted gross income, and taxable income in the following situation. Use the exemptions and deductions in the table to the right. And explain how it was decided whether to itemize deductions or use the standard deduction. Here's the situation. A man is single and earned wages of $54,200. He received $380 in interest from a savings account. He contributed $600 to a tax-deferred retirement plan. He had $1,500 in itemized deductions from charitable contributions. Okay, so let's first find out what his gross income was. So to find the gross income, that's going to be the amount of his wages plus interest, in this case, from a savings account. So his wages was $54,200. We're going to add to it the interest from a savings account. That's $380. Add the $54,200 to the $380, you'll get $54,580. That is his gross income. Now for his adjusted gross income, that's going to be the amount of the gross income minus any adjustments that he may have. The gross income was that $54,580 minus any adjustments that he may have. He contributed $600 to a tax-deferred retirement plan. That's the amount of his adjustment. So if we subtract $600 from the $54,580, we'll end up with $53,980. That will be his adjusted gross income. Okay. Now, should he use the standard deduction or itemized deductions when finding his taxable income? Okay, let's see here. And then we're going to find out what that taxable income is. I have to do this at the bottom. We'll compare his itemized deductions with his standard deduction. Excuse me. Let's see. He had $1,500 in itemized deductions from charitable contributions. Now, for a single person, here's his standard deduction, $6,350. Okay. Now, if you compare those two, the itemized deductions is less than the standard deduction. You want to use the larger of the two. And if you compare that, he should use the standard deduction of $6,350 because he's going to be able to deduct more money from his taxable income. Okay? The more you can deduct, the less tax you have to pay. So, using the standard deduction would be best for this single male. Now let's find out what his taxable income is going to be, and I'm going to need to pull this up a bit. To find his taxable income, we're going to do the adjusted gross income minus any deductions and exemptions. So here your adjusted gross income was at $53,980. We're going to subtract from it all of his deductions and exemptions that he has. Let's see. He is entitled to the standard deduction of the $6,350. We're also going to deduct, since he's a single person, only one exemption of $4,050. Okay? Because each exemption is $4,050. So if we subtract those figures, if I do the math here, $53,980 minus $4,050 minus $6,350, you'll end up with $43,580. That's going to represent the taxable income for this single man. Okay. Okay, here's another example. Compute the gross income, adjusted gross income, and taxable income in the following situation. Use the exemptions and deductions in the table to the right, or use the standard deduction. Sarah is married, but she and her husband filed separately. Her salary was $52,300 and she earned $530 in interest. She had $3,750 in itemized deductions and claimed 4 exemptions for herself and 3 children. And we want to first find out what her gross income is. Let's start with that. So to find the gross income, we're going to take the wages, add that to her interest from a savings account. The wages was $52,300. In interest, she earned $530. So if we add $52,300 to the $530, we're going to end up with $52,830. That's her gross income. Now for her adjusted gross income. Her adjusted gross income is going to be the gross income minus any adjustments. So in this case, her gross income was at $52,830. We're going to subtract whatever adjustments that she has here. And by looking at this, she doesn't have any adjustments. She doesn't have any amount of money that she contributed to a tax-deferred plan. So that's zero, which means her adjusted gross income is $52,830. Okay. And now we want to know, should she use that standard deduction or itemized deductions when finding her taxable income? Well, let's look at her standard deduction. That's this amount, $6,350. Itemized deductions here. Now, it says here she has $3,750 in itemized deductions. So now you can see here her standard deduction is more than the itemized deduction. So the best advice for her is to use the standard deduction. Okay, because it's going to deduct more money from her taxable income. And they'll give you a choice of answers here. So here you want to select this answer where she will use the standardized deduction as it would deduct more money from her taxable income. Now let's find out what that taxable income is going to be. Okay. So her taxable income, that's the adjusted gross income minus any deductions and exemptions. Now, the adjusted gross income, we found that out to be $52,830. We're going to subtract whatever deductions she's allowed. Okay, we're going to do the standard deduction instead of the itemized deduction of $6,350. Minus. Now, her exemptions per person is $4,050. She's claiming 4 exemptions. So in this case, we got to do 4 times $4,050 because each exemption is $4,050. She's claiming herself and her 3 children as exemptions. That's where the 4 times $4,050 comes in. So now, let's do this in the calculator. We're going to do $52,830 minus the $6,350 minus, and I'm going to put 4 times $4,050 in parentheses. Okay, I'll do this over 52,830 minus 6,350 minus, and then left parentheses, 4 times 4,050. And then hit enter. Her taxable income will be $30,280. Okay, that's the taxable income for this individual. Okay. All right, next we're going to look at tax rates. A progressive income tax means that people with higher taxable income pay at a higher tax rate. And marginal tax rates are assigned to different income ranges or margins. So this is what a 2017 marginal tax rate table would look like. Okay, and that includes standard deductions and exemptions, as you can see on at the bottom for each of the 4 categories: for single, married filing jointly, married filing separately, and head of household. Okay. And it is a progressive. That means it builds. Okay. So if someone, starts with 10%, and then for a single person up to $93,325, and then for 15%, they have to pay the $93.25 times 10% plus any amount up to $37,950, and it builds and builds and builds, as you're going to see in this particular example 6 that I'm going to show you. Here you're going to use the marginal tax rates in the table below to compute the tax owed in the following situation. Here, Bobby is married filing separately with a taxable income of $6,700. And we want to find out how much tax that this individual owes. Okay, now $67,000 based on this, and this is their taxable income, by the way. That's after all the standard deductions and exemptions are done. Taxable income is going to be what we're going to tax her on, so we can find out what tax she's going to owe. That $67,000 falls right here, up to $76,500, because that amount is less than $76,550. So she's going to be taxed on the 25%, and on 15%, and 10%. Okay. This is what she will owe. She's going to owe 10% on the first $9,325, because this is 10% up to that. She's over the she's over that amount. So she'll be taxed on that 10% on that first $9,325. She's going to owe 15% of the amount that's at least $93.25, but less than $37,950. And what's going to happen is we're going to subtract these two amounts here. So it'll be best for me to just say this. $37,950 minus the $93.25. And then $25% of the amount that is above $37,950. Okay. She has a taxable income of $67,000. So whatever is above $37,950, she will be taxed on that amount, on that. Okay? So a better way of saying that would be, if I do this, her taxable income $67,000 minus that amount of $37,950. That would be the difference over that. Okay? I know that sounds a little bit complicated, but that's how the tax system works and how they do things like that in the tax rate. Probably easier to use a tax table, but when you're over a certain amount, then you have to use that tax rate. Okay, let's start with 10% of $9,325, and then plus 15% of this amount, $37,950 minus the $93.25, and then plus 25% of, I just say times, by the way, the $67,000 minus $37,950. Let's simplify this. 10% as a decimal will be 0.10 times 93.25 plus 15% as a decimal will be 0.15 times, if I subtract 93.25 from the 37,950, I'm going to get 28,625 times 0.25 times 37,950 from the 67,000 would be $29,050. And all of this I'm going to type in the calculator. So in this case here, 0.10 times 93.25 plus 0.15 times 28,625 plus 0.25 times 29,050. And in this case, we're going to round to the nearest dollar. That means to the nearest whole number. It's going to be $12,489. That will be the tax that this person owes. And this should read taxable income. This should be the tax owed. That's going to be the tax that this individual owes based on the taxable income of $67,000. Okay. All right. Here's another example of this. Okay, don't worry about this one. This has the same dollar amount, the same situation where that person is filing separately, but it is going to be done the same way. Here's example 8. Here we're going to use the marginal tax rates in the table below to compute the tax owed in the following situation. In this case here, Paul is a head of household with a taxable income of $5,600. He is entitled to a tax credit of $6,500. Okay, so let's look at this particular situation for Paul. $5,600 here, so we know he's going to owe. We'll start with 10% up to the $13,500. So, and he's over that amount, so it'll be 10% of $13,350 up to $5,800. So $50,800. So that's 15% of the difference of $50,800 minus that $13,350. And then 25% of, now this will put him in this category right here, because here he's between $50,800 and $131,200. Okay, so we're going to subtract the $56,000 minus the $50,800. And not $131,200 because he hasn't reached that amount. Okay, so we have to take that minus the $50,800. Okay, so now let's look at the amount of tax he's going to owe. 10% of that would be 0.10 times $13,350 plus 15%, which is 0.15 times, if I subtract 50,800 minus the 13,350, you're going to get 37,450. And then plus, I need to do this on second line, 0.25 for 25% times 56,000 minus 50,800, you'll get 5,200. Now he is entitled to a tax credit of $6,500, so we know we're going to need to subtract $6,500 from all of this. So here, if I do 0.10 times 13,350, add to it 0.15 times 37,450 plus 0.25 times 5,200, and then subtract from it $6,500, and, well, as a decimal, as they want it, he's going to owe $1,752.50 for tax. So Paul will owe $1,752.50 based on the taxable income of $56,000 and a tax credit of $6,500. Okay. And by the way, let's talk about what tax credits are and deductions. As a rule, tax credits are more valuable than tax deductions. What a tax credit does, it reduces your total tax bill by the full amount of the credit. A tax deduction reduces your taxable income by the amount of the deduction. Okay? That's the difference there. Tax deductions reduces your taxable income. but tax credit reduces your total tax bill. So let's look at example 9 here. A man is in the 28% tax bracket and claims a standard deduction. How much will his tax bill be reduced if he qualifies for a $1,400 tax credit? Okay. In this case here, what the tax credit is going to do, it's going to reduce the total amount of his tax bill by that full amount. So here his tax bill will just be reduced by $1,400. Okay? So his tax bill is just going to be reduced by $1,400. And pretty much there's not much math right there for you to do right here. Okay, now the next example, determine how much the following individual will save in taxes with the specified tax credits or deductions. Rosa is in the 15% tax bracket and claims the standard deduction. How much will her tax bill be reduced if she makes a $300 contribution to charity? Well, that's an itemized deduction here. Now we know we can't claim a standard deduction and an itemized deduction. Okay? We know that the standard deduction is going to be way more than the itemized deduction of $300. So here, she's not claiming any tax credit, so her tax bill will be reduced by 0. Okay. So here, this will not, because by claiming that standard deduction, it's not going to have an impact on her tax bill, even if she makes contributions to charity. Okay, next example. Determine how much the following individual will save in taxes with the specified tax credits or deduction. Okay, in this case here, Rosa is in the 25% tax bracket and claims the standard deduction. How much will her tax bill be reduced if she makes a $400 contribution to charity? That's pretty much the same as that other example there. Okay, she's claiming the standard deduction, which means she can't claim the itemized deduction. Okay, so her tax bill will be reduced by nothing, 0. Okay, look at example 12. Consider the following choices between paying rent and making house payments, including the amount saved by taking the mortgage interest deduction. Determine whether the monthly rent is greater than or less than the monthly house payment during the first year. Assume the person itemized deductions. In this case here, person is in the 28% tax bracket. The apartment rents for $1,400 a month. Her monthly mortgage payments would be $1,900, of which an average of $1,800 per month goes towards interest during the first year. And then you're going to choose one of these answers here. Okay, and I'll let you read through those. Part A, it is cheaper to rent as the monthly rent is less than the mortgage payments. It is cheaper to rent as the difference between mortgage expense and mortgage deduction amount is greater than the monthly rent. It is cheaper to own as the entire mortgage payment is tax deductible. It is cheaper to own as the difference between mortgage expense and mortgage deduction is less than the monthly rent. All right, let's take a look at what the mortgage deduction is, how to calculate that. In this case here, that's going to be the tax percentage of 28% of the interest. And that interest was $1,800 right here. Okay? So if I take 28, change that to 0.28 times $1,800, this will give you $504. So the mortgage deduction is $504. Now let's look at how we can find what they call the true monthly cost. That would be the mortgage payment minus the mortgage deduction. Now here the mortgage payment was $1,900 minus the mortgage deduction of $504. So if we subtract 1900 minus 504, you're going to get the true monthly cost of $1,396. So, would it be cheaper to own based on this amount compared to the monthly rent of $1,400 per month on the apartment? If you compare those two, it would be cheaper for her to own a house than it would be to rent an apartment. And that is because the difference between the mortgage expense and the mortgage deduction amount is less than the rent of $1,400. Not by much, but it is less than. Okay. Let's talk about Social Security and Medicare taxes. Some income is subject to Social Security and Medicare taxes, which are collected under the name FICA, or Federal Insurance Contribution Act taxes. FICA applies to the following: income and wages that includes tips and self-employment. But FICA does not apply to the income from interest or income from dividends, profits from sales of stock. Okay? The only time we apply FICA is when you have income from wages, and that does include tips and from self-employment. Okay? So in example 13, for the person below, calculate the FICA tax and income tax to obtain the total tax owed. Then find the overall tax rate on the gross income, including both FICA and income tax. Assume that the individual is single and takes a standard deduction. Okay, so let's start off by finding out what his FICA tax is. By the way, it says here, a man earns $26,000 from wages. And here we're going to let FICA tax rates be 7.65% on the first $127,200 of income from wages, and 1.45% on any income from wages in excess of $127,200. Okay, so we're going to find the FICA tax. So here we're going to be The FICA tax rate is 7.65%. 7.65% as a decimal will be 0.0765. That's multiplied by his wages of $26,000. So if I do 0.0765 times 26,000, this will be $1,989 exactly. So the FICA tax is $1,989. All right, now we're going to find out what his income tax is. We need to start off by finding out what his taxable income is. Let's see, his taxable income will be this. The amount of his wages of $26,000 minus, he's going to take a standard deduction of $6,350, so we can subtract that. We can also subtract the exemption. He's just us. We're going to assume that he is single, so one exemption at $4,050. So 26,000 minus 6,350 minus 4,050 will give you $15,600. That's his taxable income. All right, now we're going to use that tax rate table above that you see here to determine the income tax that he will owe. Okay, we're starting off with, we know he's got $15,600, so here we start off with 10% of the $9,325. And then 15%, and this is up to $37,950. He has a taxable income of only $15,600. So we use that $15,600 subtracted from the amount above it for the 10%, $9,325. All right, so let's calculate these. 10% is 0.10 times $9,325, which is in this case, I'll go and do that, 0.10 times 9,325, it would be $932.50. And this will be 0.15 multiplied by, if I do 15,600 minus that 9,325, we'll get 6,275. And 15% of 6,275 will be $941.25. $941.25. So his income tax, let's say that, which is actually going to be the tax that he will owe. That's going to be that $932.50. We're going to add to it that $941.25. Plus nothing else. We'll just add those two. This will give me $1,873.75. But if we round it out to the nearest dollar, as they say, it's going to be $1,874. That would be his income tax. And now for the total tax that he owes, the total tax will be that FICA tax that we found in the first part of the problem, plus the income tax that we found in the second part of that problem. In this case here, the FICA tax was $1,989, plus the income tax was $1,874. If we add those two together, you're going to get $3,863. That represents the total tax. And then finally, his overall tax rate. Now, the way we find the overall tax rate, you have to take the total tax, divide that by the gross income, multiply that by 100%. So for that total tax rate, overall tax rate, the total tax was $3,863. Divide that by the gross income, that was $26,000. Multiply that by 100%. And if we round that off to one decimal place, 14.857% would be 14.9%. So in this case here, his overall tax rate was 14.9%. Okay. Okay, here's another example. For the person below, calculate the FICA tax and income tax to obtain the total tax owed. Then find the overall tax rate on the gross income, including both FICA and income tax. Assume that the individual is single and takes the standard deduction. In this case here, a man earns $49,800 in wages and tips, and he has no other income. Okay, so let's start off by finding out what that FICA tax is going to be. And again, we're letting the FICA tax rates be 7.65% and 1.45% on any income from wages in excess of $127,200. The first $127,200 will be the 7.65%. Okay. That's 7.65% of that $49,800. And 7.65% as a decimal is that 0.0765. Means you need to multiply $49,800. And we're going to round to the nearest dollar, by the way. So this amount would be $3,810. Okay? To the nearest dollar means to the nearest whole number. Okay? That's his total FICA tax. All right, now let's find out what his income tax is going to be. You first have to find out what the taxable income would be. Let's see. He has wages of $49,800 minus, okay, he's single, taking a standard deduction. So he's going to take the standard deduction of $6,350, and then I'm going to subtract from it the one exemption, he's single, $4,050. So $49,800 minus $6,350 minus $4,050 would be $39,400. That is the taxable income for this male. And now we're going to find out what the income tax is going to be, okay, based on this tax rate. So I know we got to start off with this number right here, 10% of the first $9,325, because the taxable income is $39,400. Well, that's more than this right here, that $37,950. So we're going to do 15% of, and we got to do the difference of that $37,950 minus this amount above that table, $93.25. Now, since this $39,400 is above the $37,950, we go to the next row. 25% of. Now, since he hasn't reached $91,900, we have to take what that $39,400 is. We'll take that minus this amount, $37,950, because that's going to be $27,000, 25% of anything over $37,950. Let's do the math. 10% is 0.10 times 9,325. I think I did this before. $932.50 on the calculator. I'll do it again. Okay. 15% is 0.15 times, in this case, $37,950 minus $93.25 would give me $28,625. That amount times 0.15 would give me $4,293.75. And then the 25%, that's 0.25 times, and I'll subtract 39,400 minus 37,950. That'd be 1450. 1450 times 0.25 would be 362.50. So now, to find out what the income tax is, I'm going to add these numbers up together. Then, excuse me, your income tax, that's the $932.50 plus the $4293.75 plus 362.50 This will give you $5,588.75. Now, they say round to the nearest dollar, so this will be approximately $5,589. Okay. That will be the income tax. Okay. And now for the total tax. That's the Fica tax that we found in the first part, plus the income tax in the second part. So the Fica tax is that $3,810. We're going to add that to the income tax of $5,589. That total will be $9,399. That will be the total tax that he will owe. And now for the overall tax rate. That's going to be the total tax divided by the gross income multiplied by 100%. Now that total tax is $9,399. His gross income was $49,800 times 100%. So $93.99 divided by 49,800 times 100. That would give me, to one decimal place, 18.9%. Okay, that will be the overall tax rate for that individual. Okay. Okay, this is the last thing in this video, tax-deferred income. Tax-deferred savings plans allow you to defer income taxes on contributions to certain types of savings plans, and these include the following: individual retirement accounts or IRAs, qualified retirement plans or QRPs, and 401k plans. Okay. So now let's look at this last example for this video. Here we're going to calculate the change in monthly take-home pay when the following tax-deferred contribution is made. Here a person is single and has a taxable income of $20,000. The person makes monthly contributions of $100 to a tax-deferred savings plan. So we want to find out what the monthly take-home, how much is that monthly take-home payment being reduced by. Okay, so now we have a marginal tax rate. By looking at this, that marginal tax rate is going to be 15% based on that table, because her taxable income of $20,000 is between $9,325 but less than $37,950. So we use 15%. So the marginal tax rate for this individual is 15%. Okay. Now, to find out what here her monthly contribution what's going to happen here is going to reduce the tax bill by this amount. If I take 15% of her monthly contribution of $100, 15% is 0.15 times 100. That will equal $15. So she is reducing her tax bill by $15 by making monthly contributions of $100. So her monthly paycheck or take-home pay goes down by this: $100 minus the $15. That's going to be $85. So that means with those contributions, her monthly paycheck will go down by $85. Okay. All right, so this concludes this video on a applicable thing that is in real life, income taxes.